Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Thursday. It is December the 16th. It is 8:17 in the morning. I'm getting a little late start today. I actually did this on purpose because I wanted to see how the market was going to look about an hour and a half before the opening bell. I usually do this about an hour earlier than this, but I wanted to give it a little extra time. The market's going to open up in about an hour and 13 minutes. And as you could see here, boy, oh boy, the markets are bullish. Small caps are rocking and rolling. I mean, really rocking and rolling. NASDAQ is going crazy. The Dow Jones is doing really well. S&P, everything across the board is singing today. And I mean singing today. Basically, let's talk about the global economy, and we'll talk about what happened, why, and we'll get into all the details, and I'll give you guys what you should be paying attention to. So the Fed said yesterday that it would likely raise interest rates, 3 times next year to tackle rising inflation, which will shrink its monthly bond purchases at twice the pace it previously announced, in line with ending them altogether in March. This is quite a stark difference between what Mr. Powell, Fed Chairman Powell, promised us about a year ago. But I think this is very positive, and I think this is going to bring inflation as much as possible into the right zone. It's not going to undo it completely, but it's going to start making a difference, I believe. Central banks in Europe were not expected to follow suit. Things are worse over there. Now, there's tensions simmering between Beijing and Washington, casting a shadow, analysts say, after the U.S. House of Representatives passed a resolution to ban imports from Chinese region due to concerns about labor force and other abuses. This has been a bigger issue. People trafficking, forced labor, it's been a big issue last few years. And America is really taking it very seriously, which is a good thing. Germany, oh boy, they've got really bad infections of COVID. They're having another wave. But from what I understand, it's not the Omicron, it's still the Delta variant. And in South Korea, people have been struggling to beat back rising caseloads as well. So South Korea and Germany, they're still struggling. U.S. central bank said its monthly bond purchases are no longer needed, with unemployment falling and inflation at a near 40-year high. Folks, they should have taken action earlier. This is them putting their head in the sand. I'm giving you my 5 cents, but they should have taken action a lot earlier. Jeff Zananeri and I were talking about this yesterday during the midweek roundtable. If you go to the Wealth Press YouTube channel, you could find a link there. Highly recommended. We spent a bunch of time talking about this. The accelerated timetable puts the Fed on a path to start raising rates as soon as the first half of next year. I'm looking forward to that. I think it's about time. That may put a little pressure on the real estate market and on speculative stocks. But I don't think they're going to do as much as they say they will, which is why we're seeing such a rally in tech. Central banks policymakers had been expected to announce a faster pullback in the last meeting of the year. That's exactly right. Businesses have been dealing with supply chain problems, which I think are mostly priced into larger stocks. Higher costs for months. It has been a key concern for investors as big companies pass those costs off to us, the consumer, who've been so far absorbing higher prices on everything from groceries to clothing and other consumer products. Now, so things are still shaky, but we're looking a little better. We're in the neutral zone right now. We're not oversold anymore. Excuse me. But it looks like we could still go higher on the market, which means this will become lower. Also, we're getting confirmation from the VIX index. As you can see here, it's now at 18. This fear that we saw, as I correctly gave you my theory, is done, and we're going to go back into the smooth zone. The bond market is lower. We're looking to get back into, this looks like a head and shoulders, and it looks like we're going to go down to the base, which would make us profitable because we are short bonds in several of our programs right now. So I'm looking forward for that happening today. And also, when you're looking at the industry heat map, I want to show you the stocks that have been rising the last 5 days. You've got large cap pharma. You've got consumer staples, utilities, staffing. This is very important. We got to take a look at this. Utilities, again, defensive stock. Real estate developers, REITs and real estate developers, medical, utility, financials. This is what's been doing well in the last 5 days. In the last month, you pretty much see the same type of things. Consumer staples, real estate, utilities. Where's utilities? Electric power. So right now, the big money flow is not coming into tech. It may start up again, but it's not there right now. Now, looking at the stock fetcher at my different indicators, I want to look at the 11 sectors and show you guys what's going on. So consumer discretionary and tech is still up there. Consumer staples now is not in the 9th place. It's now up here. So the consumer staples, defensive stocks, utilities, consumer staples are starting to come back up. Basic materials and industrial are in the bottom right now. And I like these stocks. I may want to buy some more of these stocks because I think next year material and industrial are going to go up, up, up. Real estate is doing really well. Consumer discretionary and tech. Let's look at the chart so we can kind of figure out what's going on. Technology came back with a big, big vengeance, and I think we'll have a little bit more, but then we're going to fold. Whenever you have these huge, huge volatility moves, they don't sustain themselves. Consumer discretionary, be cautious, because if we reverse today, this trend is lower. It can continue being lower. So I would say consumer discretionary is the most vulnerable sector right now. These two, a lot of vulnerability. These can turn on a dime right now. Healthcare is doing really, really well, a lot better than I thought it would, quite honestly. I thought healthcare was going to subside because there's less fear of the O variant, but healthcare has gone up. So I was totally 100% wrong here. Real estate is doing well. We thought it would do well. I think it's going to continue doing well. I think energy is going to start coming back up again. Inflation next year is coming, folks, and energy and inflation are best friends. Utilities, as you see here, utilities are doing really well. Look at consumer staples. Hey, I warned you this was going to happen. I literally warned you that this was going to happen. I told you that large cap dividend stocks are going to be in focus and away from the speculative stocks. This is why I'm so cautious about consumer discretionary and why I'm liking consumer staples so much. Keep your eye on consumer discretionary and staples. They may reverse course if consumer discretionary breaks up above the 2010 level. But so far, I'm still kind of I'm not all that bullish on consumer discretionary because of rising rates, and I'm very bullish on consumer staples. Utilities are doing well. It's defensive energy is doing well. Financials should start rocking and rolling again because rates are going to go up. Communication sector needs to reverse, and I think we have a catalyst unless we make a double bottom here. Industrial, I like. I know it's not doing that well, but I'm telling you, I think we're going to have a turnaround. I think we're going to have a reversal with consumer discretionary and technology starting to cool off. Maybe not today, but over the next couple of weeks, and industrial and basic materials starting to come up. I really, really like these stocks a lot. That's my prognosis. Let's look at Econo so we could see what news is coming out today. And you will see that today we don't have a lot of big data. Yesterday was all the big data. So today we don't have anything. We have option expiration. Expect a lot of volatility, a lot of trading range, a lot of monkey business. That's right, I said it, monkey business in the market, but all of the data was yesterday. Now, if you look at the SPY right now, you will see that the SPY is looking really, really bullish. Let's just take a quick look at it here. It's looking very bullish. Looks like it's breaking out. It's going to make an all-time high this morning, I believe. NASDAQ, let's take a look at the NASDAQ 100. NASDAQ looks really, really bullish. But let me tell you, today I'm supposed to give you the top ETF and the top option. I've got something for you. I want to show you this. Look at the Russell 2000. Pay attention. Pay close attention. It is showing us a lower low here. But look at RSI. It's not. That's telling us it's bottomed out, and now it's already higher. I like the Russell 2000. More importantly, let me show you something else. You guys got to see this. Look at the number of stocks in the Russell 2000 trading above the 50-day moving average. And look at where we're at right now. Look at where we're at. Look at where we're at. Look at where we're at. This is COVID. That doesn't count. Let me go to a 10-year chart. Let me change it for you. Look at where we bottom out around here. And it looks like we're bottoming out. It looks like we're turning. If you could probably see it better on a weekly chart. Yeah, look at that. Bottom, bottom, bottom. COVID. Sometimes we go lower, but the bottom line is I think we're turning. And right now, it's one of my top stocks. So here is what I would be doing right now. And I'm long, by the way, in one of our programs, the Russell right now. I would be going long the Russell, and I think once it passes the 50-day moving average, it's going to rock and roll. It has been choppy. It has been in this zone all year, and I think we're going to break out and test the highs real soon. If I was an option buyer right now, I would be looking at the monthly expiration for March, and I would be looking at probably the 220 strike price. Yeah, 220 strike price looks good right here. And it's got plenty of liquidity, plenty of open interest. And if you want to do a spread, you could buy the 220 and you could sell the 227. Buy the 220, sell the 227, expiring in March. Overall, markets are going to go up today unless there's some hanky-panky because of triple or quadruple witching. But things are looking stable, and I think we're going to have a nice little run-up. Be very cautious with consumer discretionary and tech. Chip stocks, I'm a little cautious with chip stocks right now, but overall the market's looking good, and I like the small caps and blue chips right now. Now, before you go, I've got something really important for you. Folks, Joy of the Trades, Jeff Zananeri, he's celebrating the first anniversary of Burn Notice alerts. The strategy issued at least 4 alerts per week, and last week, all 4 were winners. Yay! Good going, Jeff. With so many chances to play the market, his best students have enjoyed profits like 69% on BA, 113% on GOE, 126% on Facebook, all overnight. No day trading margin. You don't have to wonder what happens. You get in a trade, you go to bed, next morning, ba-boom! 4 winners in a row. Click the link below to learn more about Burn Notice alerts and how anyone can add this amazing strategy to their toolkit. As always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. I want you guys to stay ahead of the market. The best way to do that is by subscribing to these videos, and I'll notify you when I post the next one for you. And again, folks, Jeff Zananeri, it's a burniversary. It's a burniversary. It's a 1-year anniversary. He's gonna open up the spreadsheet. He's gonna show you the trades. He's gonna explain everything to you. You don't want to miss this out. Join Jeff, Burn Notice alerts. Anyone can learn how to use the strategy. Learn how to add it to your trading toolbox. Click the link below. Do it now. And again, we're going to have a bull market. We may have to take some profits today. We took a profit, 103% profit and 26.5% profit off the table yesterday. And today we may have some more on the table. Bye, guys. Talk soon.